smart board still. I'm going to talk to them again, and it'll be fixed by next time. Today what I want to talk about really is how, it's kind of what we've had the whole time, but how the financial markets actually work, how they function in terms of, it's normally what we refer to as market microstructure, is the term you might hear for this. And it's really concerned with, it's actually the technical workings of how prices and trading is done in the markets. And it really determines the way a lot of things work at an underlying level. You don't see it a lot in security valuation, actually, because it's more practical. It's not as abstract as some of the theories you see in security valuation, like in an investments class. But it determines a lot of stuff like the information you get, like why you get quotes in a certain format, what kind of information you get when you get quotes, and how your trade's actually processed. When you want to buy or sell a security, such as a stock or an option, how that trade's actually sent to the exchange and how it's actually processed and how it's actually done. It's all related to that. And so I want to look at some of that stuff today. I'm sorry I can't write it on the smart board. I don't have any markers to write on the actual board, so I'll write some of these notes out in Excel as we go. So when you buy and sell securities in the market, you can generally make two different types of orders. You can make what's called a market order or a limit order. And a lot of you are probably familiar with these already. So a market order is just when you as an investor, it could be either a small, regular individual investor, or it could be a large institution. But when you make an order, so you submit basically a bid to buy some security, if you submit that order in such a way that you want to buy that security, and you tell them how many shares you want, and you want this order executed as soon as possibly, which usually means immediately. Immediately actually means a couple seconds or milliseconds, depending on where you are and what kind of system you have that connects you to the exchange. But if you want your order executed quickly, but you don't have control over the price you get, so what you do is you submit a market order. You get your order executed as soon as possible, but whatever the currently available price is. So it's like you have to buy now, and you'll get whatever price is being offered out there in the market. So with a market order, the order is executed immediately. And at the best available price. And as far as what the best available price is, that's whatever people out there in the market are currently offering. So if you want to buy a security, it's not executed right. When a security is actually traded, that is, ownership is transferred from one person to another, that's called an order execution. So when we say execution, it means an order that's actually processed, and then security changes ownership from one to another. That's an order execution. And some other terms that you have. A bid is an offer to buy a security. And an ask is an offer to sell a security. So you can submit a bid order or an ask order, and that order could either be a market order or what we call a limit order. And then a limit order The difference between a limit order and a market order is a market order gets executed immediately, just at whatever price is available. A limit order, you specify the price at which you want to buy or sell, and if that price is not available immediately, you might have to wait until your order is executed, and it might never get executed if that price never becomes available. So for example, if you want to buy a stock, you want to buy 100 shares of Apple. I don't know what the price is right now for Apple. Check quickly, I guess. The price right now is $101.15 for a share of Apple. Say you want to buy one share. You can say, I want to buy that. I don't want to pay $101.15. I will pay at most $100 a share. So you could say, I'm going to submit a limit order offering to buy Apple at $100 a share, and that order then will go what we call onto the limit order book. There will be some type of register. It used to be an actual paper book, but now it's all done electronically. It's basically a big spreadsheet. And running that big spreadsheet, that's what the New York Stock Exchange or NASDAQ does. That's what the exchanges actually do. That's their main business model, is just to run this big spreadsheet. And so your information, like your name or your account number, whatever it is, it'll be put on there, and it'll say you're willing to buy 1 share of Apple at $100. And then usually there will be some other conditions you can attach to it. And you'll say this order is good for an hour, until the end of business today, or until the end of the week, or forever. And so you can specify all sorts of things on there as far as how long that order lasts. And you can specify stuff like if it's for 1 share, 100 shares, if you need to get all those shares, or if it can be partially executed. You can specify all sorts of conditions, but the main thing is whether it's a market order or a limit order. So that limit order won't be executed immediately, and it may never be executed, but when it does execute, you know what price you're going to get. You'll get whatever that price is that you specify in the limit order. Now, if we submitted a market order to buy Apple right now, we'll get whatever the best order is that's out there on the limit order book, which right now, if I take a quote for Apple, it looks like this. So right now, the price you would get is roughly 101.18. So if you want to execute your order immediately, you don't get to buy Apple for $100. You got to pay a little bit more. You got to pay 101.18. And then these orders, they just come in all the time. Whenever the market's open, these orders are submitted through the exchange. And if you're submitting a market order, which is an order to buy, then your order is going to be executed against whatever the best available ask price is on the limit order book. So an ask is an offer to sell a security. So other people in the market, they're submitting limit orders to sell securities, and they might say, I'll sell Apple for $102 or $101.15. And if the price isn't currently there right now, that'll just sit on this limit order book. And whenever somebody submits a market order, then it'll execute, and those shares will be exchanged, and ownership will be, change in ownership will happen, and that's how the trade is executed. There's lots of different ways you could kind of structure a market. This limit order book, this is basically how modern stock exchanges, pretty much every modern stock exchange or derivatives exchange in the world, they all function the same way with this electronic limit order book. But it's not the only way you could do it. I mean, you could instead of having an order book like this, you could have a bunch of people standing in a room, and they basically yell at each other at what price they're willing to trade at. And that's how markets used to work, especially derivatives markets, up until fairly recently. And so they didn't have any books written down with all this stuff. They just had people there negotiating, basically like a big auction where somebody gets up and talks and says what price they want to sell something or buy something at. And if somebody agrees to that price, they basically raise their hand and they say, I'll buy or sell it for that price. And you can do it that way. That's another way. Another way you could do is you could actually have all the shares of stock or their prices written down on pieces of paper, stick them up on shelves in a big store, and people would walk in and grab whatever piece of paper they wanted and actually take it up to like a checkout counter and buy it. And that's how normal stores work. But you could sell stocks the same way. It just wouldn't be very efficient because you got all these pieces of paper and people are going to carry them around and it's slow and everything. But you could conceptually do it that way. And stocks have been traded in the past exactly that way, back in older times when people weren't really so much concerned about speed and they were concerned about actually keeping track of the records really accurately. So now everything's this limit order method is how these markets work. And in particularly, in the last 20 years, they've all been evolved from being what used to be just a limit order book, which is actually a physical paper book, to being an electronic limit order book, which means there's no longer a physical book. Now it's all basically an electronic spreadsheet, essentially is what it is, but a big, really complicated one. And running that software for that electronic limit order book, again, that's essentially what the New York Stock Exchange or NASDAQ or any of these other stock exchanges, that's their primary function. That's what they do. They just run this software that processes and keeps track of all these limit orders. And then whenever a market order comes in, it basically adjusts the limit order book and changes the ownership of the security to reflect the fact that somebody's bought a security, and so whatever's on the limit order book is changed a little bit. And it used to be that this limit order book was updated every couple minutes or seconds, and now, especially in the last 5 years even, the timing of this gets faster and faster as they get better and better computer systems. And now the electronic limit order book is updated in milliseconds or whatever, which is like thousandths of a second. And so you got a lot of firms that are submitting these orders very quickly, thousands of times a second even, and transferring orders back and forth, being market orders or limit orders out there. And this is what we hear is a lot of being, we hear a lot of stuff now about high frequency trading, which is really just taking advantage of using really sophisticated computers to submit and process and trade really quickly with a lot of these electronic limit orders and electronic market orders. And you'll see stuff like algorithmic trading, which is really just using mathematical or computer type formulas, artificial intelligence, to basically submit a lot of these orders through the books. And there's especially some regulators, not many regulators, but especially politicians who find that to be very scary because they don't really understand like the math behind it, and so they think it must be a really scary, evil thing, and it's going to destroy all the markets, and so they talked about shutting it down or regulating it. But in a way, there's no real evidence for some of those things, but there's some good best-selling books about how scary it is. There's one called Flash Boys, and another one that's going to be a movie soon. And so you'll see more about this stuff in the next couple of years, and it gets in the press a lot because people are interested in reading things that are kind of scary and hard to understand. So there is a bunch of stuff in the news and stuff about it also, so you'll see it regularly. Questions about it so far? Okay, let's look at, what I want to look at then, especially since I can't write everything out here so easily, are some of the quotes that we'll see. And basically I want to look at how these are related to microstructure and everything else we have. So I took here an example with Apple. If we click on it and get a quote actually for Apple, a lot of what the information you have is, it reflects what we have here, then what's basically happening in the electronic limit order book. That's what a lot of stuff here actually is. So this is, again, a typical stock quote. So this is, the type of security is stock, traded on the stock market. The way you can tell some of these things with Apple, so you get the name of the firm, then you got a ticker symbol. Every firm that trades on any exchange, generally firm names are too long and not standardized, so they all have short little abbreviations for every firm. It's called a ticker symbol. It's usually anywhere from 1 to 5 letters, sometimes with numbers mixed in. Basically, the older the firm, the shorter the ticker is. So old firms just have 1 letter. Newer firms have 4 or 5 letters a lot. A lot of the funds out there will have longer tickers. In addition to the ticker, you'll also see things, something called a CUSIP, C-U-S-I-P. That's another unique identifier for any security, and we looked at that when we looked at Treasury securities on Treasury Direct. You'll also see that a lot of times, and it's longer. It's about 10 digits. There's different versions of it. Because tickers get recycled, and so they're not always unique. When a firm goes bankrupt, then its ticker gets recycled to some new firm. So if you look at tickers over time, they don't always track the same firm, but CUSIPs are going to be more unique. One thing you have listed then, after that, you have the stock exchange that it trades on. So Apple trades on the NASDAQ stock exchange. The two main ones in the US, again, are New York Stock Exchange and NASDAQ. In old times, when there were actual physical buildings with physical limit order books written on paper, New York and NASDAQ were the two main ones, and there were a bunch of regional exchanges like 100 years ago, like the Cincinnati Exchange, the Boston Exchange, the Philadelphia Exchange. All the big cities had their own exchange because it was actually done on paper, and they had to ship the stuff around. So you had local exchanges. In the last 20 years, when these physical places were actually replaced by computer electronic limit order books, you had a whole bunch of new computer software companies that basically ran stock exchanges. And most of those have been merged or bought up by New York and NASDAQ. But you'll see names like Brute, Archipelago, iNet, and a bunch of these things. And they're basically, they were software platforms that basically ran electronic limit order books. And most of them have now been merged with the big stock exchanges. So there was kind of a transformation with it. And now, again, you still have New York and you have NASDAQ that basically run these exchanges, or at least the software that runs them. Yes?
How is it determined if it's on the NASDAQ or the New York Stock Exchange?
It's the firm's choice. The firm will choose where they want to list. And there's one's not necessarily better than the other. There's kind of some trade-offs. Some of it has to do with exact reporting requirements. As far as there's rules for listing on exchange, you have to publish information such as your accounting information, other information about the executives, how much they get paid, what your firm does, all those kind of things. Firms that are bigger, older, and with more information tend to be geared more towards the New York Stock Exchange, just because that's what it was set up for. Firms that are younger, fast-growing, without as much information, because they're younger and fast-growing, they tend to list on NASDAQ, and that's what NASDAQ was intended for. So that's a real rough distinction between them. But of course, Apple's the biggest firm out there, and you see here it's listed on NASDAQ. So not all the firms on NASDAQ are small, especially because some of those tech companies grow so much. A lot of the biggest firms out there are these giant tech companies, and they're actually on NASDAQ, not the New York Stock Exchange.
Are they allowed to switch over if they want to?
They are allowed to, and they do that sometimes, but a lot of times it's not worth the trouble. So you do see them switching sometimes, but I mean, Apple hasn't switched, so it's decided to stay on NASDAQ. And there is competition between New York and NASDAQ. There's kind of just a healthy competition. And sometimes they do switch, but not all the time. Because NASDAQ lists smaller firms, there's a lot more firms on NASDAQ than New York. NASDAQ's actually several times bigger than New York. But because the New York Stock Exchange tends to have larger firms for the most part, its total market size is bigger because it's got fewer firms, but they're a lot bigger. NASDAQ has lots of small firms and then a couple giant tech companies that have just grown really big on NASDAQ. It's probably more accurate to say that New York has old firms and NASDAQ has new firms. And a lot of old firms are big and a lot of new firms are small, but there's some big new firms like the tech companies that are on NASDAQ. So they do compete, they do switch. Firms choose which one to go on, and it's just it's their choice really. And a lot of these new large tech companies that list, there's a lot of competition between New York and NASDAQ to see where they'll get listed on. And again, most of the tech companies go to NASDAQ just because that's where the other tech companies are. And a lot of like industrial firms tend to go to New York Stock Exchange just because that's where they've always been. So you see both of those on there. In addition to those, there's also all the foreign exchanges that a firm could choose to list on, and we'll come back to the foreign exchanges a little bit. And most countries have something similar to this, like they have a big old established exchange for the old industrial firms, and then they'll have a new exchange also that lists kind of the young, growing, usually tech companies. Because that model's kind of worked well in the U.S. with the distinction between New York and NASDAQ, although they're both from Wall Street. So a lot of other countries also have that kind of distinction. They're trying to make two markets, one for big old companies, another one for new, fast-growing young companies. And so you'll see a lot like that. Okay, other stuff. So what you have on a stock quote like this. Big number there, that's the stock price in US dollars. So one share of Apple stock costs right now $101.20. So that's what that number gives you. Now, usually what people care about is the change in the stock price. So we care how much it's changed, because if you invest in it, you care whether your investment's gone up or down. And so what we have here in red is that the stock price has changed, and this is just over the trading day today. The trading day today is not going to go much longer. So over today, Apple has gone down by, see, it changes in real time. All the time it's updated by 72 cents right now. It's red because it's gone down. If it had gone up, it'd be listed in green. And then as a percentage of Apple's price, that represents a drop of 0.67% for the day. So the only place where you actually get a return as a percent is here, where you have it as a percentage, and that's a daily return. So if we wanted to know what this was for a year, we'd have to compound that out for a whole year, which if you wanted to do that, including time value of money, you'd have to take 1 plus your return, and then the exponent would be the number of days in a year, and then minus 1, so it would be this kind of compounding formula to get like an effective rate that we've used a few times, and we'll come back and look at that again. And as far as how many trading days there are in a year, there's of course 365 days in the year, unless it's this year when there's 366, because it's a leap year. Normally, stocks only trade on weekdays, though. It's closed on the weekends. Weekdays, there's roughly 250 days per year. Is how many days you have. If you take 5 out of 7 for the whole year, you get about 250 days. Every year is a little bit different depending where the holidays fall, whether Christmas is on a weekend or during the week, and whether some 4th of July is on a weekend or during the week. So some of those days it changes, but somewhere between 248 and 252 days per year are trading days. So on average, it's about 250. Okay, so you've got that main information there. Other stuff you got the previous close, which is the closing price from yesterday. You got the opening price, which is what the stock opened at this morning when the New York Stock Exchange opened or when NASDAQ opened. And then the bid and the ask. This is really the information from your limit order book there. So what you can see on the limit order book there, the bid is the price on the limit order book for people to buy that stock. And then the ask is orders on the limit order book for people to sell the stock. And so what you'll see on the limit order book, the the bid offers, the buy prices are going to be lower than the ask prices. If there was the other way around, the orders would have executed already, and they wouldn't be on the limit order book because they would have already been processed and executed. So these are the orders that have not executed yet. But you can see during the trading day, and Apple's a really actively traded stock, so there's market orders coming in all the time. So you're constantly seeing this limit order book update all the time as market orders come in every second. And this is free here, so it's actually delayed like by a couple seconds or minutes. If you wanted the instantaneous data, you got to pay your $50,000 subscription to NASDAQ, and they'll run a cable right into your computer, and you can get it in real time. But unless you're actually trading in real time, it's not worth paying all that money. So Yahoo will give it for free, but it's delayed a couple seconds. A lot of times they'll delay it like 10 minutes if you want a free quote like this. And so you have the price there that's on the limit order book, and then you have times the number of shares. So again, on the limit order book, you would submit not just the price at which you're willing to trade, but how many shares you're willing to trade in any offer. And so if they add all those together at whatever the price is, you get that amount there, how many shares are available. The difference between the bid and the ask price, that's what we call the spread for stock. So with bonds, the spread is the difference between any two yields. With stocks, the spread is the difference between the bid and the ask prices. And usually it's going to be the ask price minus the bid price then, since the ask price is going to be higher. The other thing we have there is what we call the depth on the limit order book. Which is the number of shares available. There's the number of shares available at any given price, is the depth. So these two measures here, spread and depth, these are two measures of liquidity. So liquidity refers to how quickly or easily you can trade something. We've mentioned that before, and you'll see that in pretty much any finance class. You should see a mention of liquidity. So the main measures, two of the main measures we have here are spread and depth. Other measures that we have of liquidity would be volume, and volume is the number of trades that have actually executed, so the number of shares that have actually been traded. So spread and depth, those are kind of forward-looking measures of liquidity. They're like the liquidity you would get if you were to start trading right now, what you get in the next couple of seconds by what's on the limit order book. Volume is kind of backwards looking. It's how many shares have already been traded in whatever, the current day, the current week, the current month, the current year, however far back in time you want to go. Questions?
You said on the spread it was ask minus bid?
Yeah, I mean, it's usually we care, it's more like the absolute value of it. You'll see here the ask price is slightly higher than the bid price. So if you want to get a positive number for it, you can take ask minus bid. You can also take bid minus ask, but then you just take it like the absolute value of it. So it can be done either way. We really just care about the difference, not so much the sign of it. Yes?
The volume that's listed right there, is that just today?
That is the volume today, yeah. So you see it's actually being updated, so it's going to get bigger all the time because trades don't ever negatively execute. So it's going to grow throughout the day. And then average volume below it, that's the average daily volume over the last 3 months. So today's volume, you see, is actually pretty low. It's only half what it is on average, and the trading day is almost over, actually. So today's a pretty low volume day for some reason. Normally there's about 50 million shares of Apple that execute in trades over a given day. And right now we've got 24.5 million shares traded so far today. And that's on NASDAQ. So that's Apple is one of the most actively traded stocks out there. So that's a lot for a typical stock. So we'll see that information. So we have the bid and the ask, and you see Apple is very liquid. Because it's so actively traded, it's very liquid. So you see the spread is about as small as it can be. They can only have 1 penny of difference between those prices, and that's what the difference between the bid and the ask price is right now. If you look at a stock that's not traded very actively, there might be a big gap between the bid and the ask prices. It could be, there's no limit on how big it could be, but that's a big measure of liquidity. And Apple's very liquid, so there's almost no difference. Other information you got there, the 1-year target estimate, That is a guess by analysts of what the stock price should be 1 year from now. So they're guessing $135.55. That's just the best guess. Of course, no one knows the future, so we'll see if it actually is that or not in a year. Beta is a measure of the systematic risk of the stock, which we're not going to get into too much, but if you take any portfolio theory or portfolio investments class, that's one of the main measures that you'll work with. Earnings date is when Apple's next going to announce how profitable it was. You got the days range. That's the range that the stock price has been in over today. It's gone from 100.4 to 101.76, and now it's somewhere in the middle of that. And then this is the range over the past year, over the past 52 weeks, from $92 up to $134.55. And then we got volume. Market cap is the total value of all the shares of stock for this firm. So you take the price per share here times the number of shares that are outstanding, and that would give you the total value of all the stock. And the total value for all the stock for Apple is $561.5 billion. So it is the, kind of jumped around a little bit. I think it's currently the most valuable company in the United States, the most valuable company in the world at that. So it's the biggest company. Google was up there with it for a little while. There might be another firm soon that might do an IPO, which would actually be about 10 times bigger than Apple, but we don't know if they're going to do an IPO or not. The Saudi Arabian National Petroleum Company. Yeah, if they do an IPO, they would be by far the biggest firm in the world ever, but it's unclear if they'll do an IPO or not. They're talking about it. Until then, Apple's the biggest, and sometimes Google might catch up with them and pass it slightly, but they haven't yet. Or they did earlier, but they don't stay ahead of Apple. Other firms that have been the biggest in the world over the last couple of years, Exxon was biggest for a while, Walmart was up there about a decade ago. Microsoft used to be the biggest a couple years ago, but not anymore. Mm-hmm.
So, like with the price changes in stocks, I know that like depends on like demand and
Yes.
stuff. But is that demand just dependent on confidence in the performance of the company or anything? Because like, I don't know, like the economy has done better, but
Yeah.
it's not technically, it's not done better. So like, how do these stocks, you know?
Yeah, that's a good
right?
question. I mean, that would be, you could answer that question, it would answer everything. There's an infinite number of things that affect it. And demand, confidence and demand would be, I mean, demand would be the main thing. But as far as what affects demand, everything affects demand. But confidence would be one of the biggest things. So confidence, or usually we refer to that as risk, they're really measuring the same thing. I mean, confidence would just be the opposite of risk. But that's one of the main things. And sometimes it's firm specific about that stock, about Apple in particular. Sometimes it's stuff about all stocks, so across the whole economy. And really that measure here, beta, this measures how much Apple's stock price or stock return or stock risk is specific to Apple as opposed to across all the firms in the economy. Basically, if your beta is bigger than 1, then it means your stock price is very heavily correlated with everything else in the economy. If it's less than 1, then you're less correlated with the overall economy. So Apple's is greater than 1, which means you could loosely interpret it is what happens with Apple's stock price is mostly driven by what's happening in the overall economy. And when the overall economy goes up, Apple stock goes up by even more. And when the overall economy goes down, Apple stock is going to go down by even more. If a firm had a beta of 0, it would mean its stock is just unrelated to the rest of the economy. The economy might do well, but that stock's going to do its own thing. It would be a beta of 0. A negative beta means when the economy does well, your stock goes down in price. And when the economy does badly, your stock goes up. Walmart used to be a negative beta stock, if you think about it that way, because Walmart used to be much more of a pure discounter, that it had really, really low prices. So when the economy did badly and people didn't have much money, they were more likely to go to Walmart instead of going to Sears or whatever other store was a bit fancier. So Walmart actually did better when the economy was bad. Now Walmart's kind of grown so big and it's such a big part of the economy that it's kind of too much tied with the whole economy. But now you have some of these stores, Dollar General, some of these other ones, that they do well when the economy does bad, so they actually have negative betas. So you can have firms that have negative betas also.
Is that how investors hedge?
It would be one of the main ways. It is the main sort of academic, theoretical way to hedge. As far as whether people actually use it so much in the real world is another case. The real world doesn't use beta nearly as much as finance theoreticians would like them to use it. But it's one of the main best measures we have of that. I guess in the real world, people don't use it all that much, but we don't really have a better measure than it. It's one of the best ones, and it's certainly what a lot of finance theory is based on. And really, any portfolio management or investments class, it's basically all about beta. That's going through beta until you're sick of it. All the different ways to calculate it and what to do with it, how to expand it, manipulate it, modify it, all that. That's basically investing in portfolio theory. That's what it is. Other measure we got there, PE, that's the price earnings ratio. So it's just the price of the stock divided by the profit per share. So what that means, a PE ratio of 10.77, it means this stock price here, for every dollar you pay for Apple, you're basically paying 10.77 times how much profit you would be getting. And you can see that, so the earnings per share here is $9.40. So for every share of Apple stock, Apple's producing $9.40 of profit. But a share of stock costs $100. So the share of stock costs roughly 10 times as much as how much profit you get. That's why the PE ratio is roughly 10. It's 10 times more than what the earnings are you get. And that's just a very rough measure of how the stock price is related to the profitability. And if that number is greater than 1, it basically means you expect this firm to grow or have the potential to grow over the future so that their earnings will eventually be enough to justify the stock price. And Apple's always a big growth stock, so that's why its PE ratio is high. And then here you have dividend and yield. 208, that's the actual dividend amount in dollars. So Apple pays a dividend of $2.08 per share, and that's generally paid quarterly. And then 2.02%, that's the dividend yield. So if you take the dividend amount divided by the price, so you get the dividend as a percent of the price, that's what 2.02 is. Since the price is almost $100, it's actually pretty easy to estimate it. So if you take 208 divided by 101.39, you get about 2.02%. That's not updated in real time, so it's probably whatever the price was whenever they last computed that. Questions about the information given on a regular stock quote there? And then, of course, the main thing you're given graphically for any stock is you're just given a graph of what this price has been over time. So if we take Apple's stock price over time, you stick it on a graph, you get something that looks like this. And you can click on it and it'll blow it up and give you all these little functions to play with the graph here, which of course we could do in Excel with a lot of work, but here they give you all these little toys to play with. And this is just over the current trading day. So they give you a one-day graph of the stock price. So from when the market opened this morning, actually this is pre-opening, opening here at 9:30, and the market's going to close soon. It just shows how the price went up and down over the course of the day. Now there's absolutely zero evidence after a century of people trying to show that this kind of information has any usefulness for investing or profiting or earning higher returns, lower returns, or anything else, or picking stocks. But people's brains are pattern recognition machines. That's what we're evolved or designed, created, whatever for. Our brains are really good at it. People like looking at charts and seeing patterns even if nothing is there. So this is the first thing any stock website ever shows, and people are drawn to it and attracted to it. But it's just a nice little chart. As far as what you could use it for, nothing as far as real theoretical or scientific or proven analysis in finance, but it's fun to look at. And there's hundreds of little toys here you can play with to kind of add more information to the chart, which psychologically people like to do. But psychological finance is a whole other field. So you're given these kind of charts here, and you can extract some information there from it that could be useful, but the chart itself is really just to be pretty. Other information you're given on any stock quote, you're given a lot of other links here to other information that's useful for all sorts of things about the stock. If we click on order book, this is information from this electronic limit order book. So if you click on it, what you get is a little snapshot of this actual electronic limit order book. So this is what the NASDAQ Stock Exchange has, and this is how, again, these trades are actually processed. And it's not updated in real time, but we can see what it was at least a couple minutes ago. So on the bid side of the limit order book, these are the prices that are there. So the best available price is going to be at the top of the order book. So again, bid offers are where people are offering to buy Apple. So if you wanted to sell Apple stock, if you had some shares of Apple and you wanted to sell it right away and you wanted to submit a market order to sell, the price you would get on the limit order book would be 101.34, this top of the bid side. But that's only 700 shares. So if you had, say, 1,000 shares that you wanted to sell, you'd sell the first 700 shares at 101.34, and then the next 300 shares that you have would be sold at 101.33. So your actual total price you would get would be like whatever the average is, 101.33 and some fractional amount in between there to take the average. So that's how the limit order book works. And so when you see it being adjusted all the time, they're in real time, that's what's happening. Market orders are basically being submitted and they're electronically arriving, and then it's wiping out whatever shares are on the top of the order book. And then people are constantly submitting new limit orders, so they're getting refreshed all the time also. So that's just updating that software throughout the day. That's what the stock exchange does. And the actual software that they use for it is this thing called BATS here, which used to be a computer competitor to NASDAQ, and then NASDAQ bought it and basically took their software and made it their own. That's what it is now. If you wanted to instead to sell shares, if you wanted to buy shares of Apple, then you got to look at what people are currently willing to sell to match up. So if you want to buy, you'd look at the ask side of the limit order book, because those are the orders that you're going to take the other side of. And if you wanted to buy, you could buy right now for 101.35, and there's 199 shares available at that price. If you wanted to buy more, you'd have to go further down. So if you wanted to do a really big order, like if you wanted to sell, say, 10,000 shares of Apple, you're not going to get that best price because there's only 700 shares available there. You'd have to go way down the order book, and so your actual price you would get on average would be several cents less if you had a large amount. And so if you take those and you graph it, that's where you get these basically supply and demand curves in microeconomics. They're just being extracted from something like this limit order book. This is the actual underlying source for all of that. And so that's how markets work. So any market you have out there, basically what they're doing is they're making one of these limit order books, and that's how it works. And that's how the markets all function now. Questions about it? Okay, let's look at the next thing we have here. So this was the main information for a share of Apple stock. And since stock is, again, the main security for any firm in terms of what's quoted, it's always the first thing that shows up for a quote. And the reason common stock is sort of the main security, it's just because when firms issue securities, common stock is almost always the most common. Which is not why it's called common stock, but it goes along with the name, so it's easy to remember. And what I mean is common stock is all the same. So when a firm issues common stock, almost all of it is identical. You have millions of shares and they're all identical. So there's lots of it out there trading, which is why it's very popular to trade. If a firm issues a bond, every bond is different. So Apple probably has, I don't know, hundreds of different bonds outstanding. And the thing is, each bond is going to be a much larger amount. Where a share of stock here is $101, a bond's going to be like a face value of $1,000. And every bond is different. So if you wanted a quote for Apple bonds, you'd have hundreds of different bond quotes to choose from. So it's not as easy just to get a bond quote for Apple, so that's why they're not available. You'd have to do a lot more work to find a bond quote, because there's lots of different bonds, different maturities, different coupon rates, all those different things. They're not standardized. And there's not nearly as many of them because they're larger. What we can get, though, we can also get options on Apple stock. So options are not actually issued by Apple. They're going to be issued by some other firm, usually an investment bank or futures or an options exchange. They'll issue options, and they'll be tied to the price of Apple stock. So they're going to be a derivative tied to this price of stock. So if we look at the options available, there's lots of different options. And remember, an option, it gives you the option, but not the obligation, to either buy or sell some other security, in this case a share of Apple stock, at some price over some period of time. So there's lots of different options on this one share of stock on Apple, because there's lots of different prices that you could buy it at and lots of different time periods. So there's hundreds of options available here. And you can see what you're given for options. First, you're given whether it's a call or a put option, where a call is an option to buy and a put is an option to sell. So these are all call options listed right here. So it says call. And these options are all to buy Apple stock on March 11th, 2006. So this is to buy it not today, but in 3 days, 4 days. 3 days, sorry, it's 3 days. So to buy it on March 11th. And if you wanted to buy Apple stock on a different day, if you click here, you've got a whole bunch of different dates. for options. And generally they start here being weekly. You got every week, and then you got every couple months, and then further out in the future. So you can buy Apple stock at some point in the future. And so the idea is you just want to lock in the price at which you could buy Apple stock. And now the current price is 101.37, and you could buy an option here that lets you buy Apple stock at a price of $55. So the strike price is the price at which you could buy the stock. So that would be a really good option to have, because if you had an option to buy Apple stock at $55, then you could buy it at $55, and you could turn around and sell it for 101.45, which is an automatic profit of how much? $46.44, if I did that right. So that option should be worth something close to $46.44. I mean, that would be a fair price for it. And if you look at the price here, the price is $46.35. So it's something pretty close. No, it's not exactly the same, because that option is not for today, it's for March 11th. So the price could still change between now and March 11th. So it's not going to be exactly that value, but it's going to be something close to it. That value is called intrinsic value. If you take the current stock price minus the strike price, the difference between those is what we call intrinsic value for an option. So the intrinsic value, what that is technically, it's a value if you exercise the option immediately. And so if it's a call option, that would be the stock price minus the strike price. If it's a put option, it would be the other way. It would be the strike price minus the stock price. So it depends if you're buying or selling the option, which way you do that difference to get the value of it. And that's the intrinsic value of an option. Now, an option price, it'll usually be a little bit more than the intrinsic value, but actually computing option prices, it has a lot of complicated math in it. You can take a derivatives class and compute that. It's usually a formula called the Black-Scholes formula, which gives you the estimate of what the value of an option should be. It depends on a lot of different things, how much time there is, what the discount rate is, and especially the volatility of the option. Because the more volatile it is, the more likely it'll reach that exercise price. Intrinsic value can be positive or negative. If it's positive, the option's called in the money. If it's negative, it's called out of the money. And so if we look, if we go down here through all these different options, you can see eventually you reach a point here at 101. So that's the current price. So you also have options here at greater than the current stock price, which means if you have this option here for 102, that gives you the opportunity to buy Apple stock for $102. Which right now you would not want to do, because you could just go to the market and buy it for 101.43. So you never want to buy it for 102 right now. But the thing is, since the option is still good in the future, I mean, it doesn't expire for a couple days, Apple's stock price could go up above 102, and then that option would be worth something. So that option's still worth something, not very much. We see what it's worth. It's worth 58 cents. Because there's still a chance that Apple's stock price will go up above 102, and then it would be worth something. So it still has some positive value, but it's out of the money, so it's not worth a whole lot. And then you can see there's basically some ones down here. You could buy these options for 2 cents a piece, and they give you the right to buy Apple stock at $145, which is a very small chance of Apple stock going up that high in the next 3 days. Not a very high chance, but that's why those options are really, really cheap. And basically, there's nobody buying them right now. As far as option information, so you got your bid price, your ask price. The last price is the last transaction price. And you see for a lot of them, there's just no trading at all today because they're too far away from the price. So it's just given as 0. You've got the change in the price for the option, the percentage change. Volume is how many of those shares, how many of those options were traded today. And then open interest is how many are available to trade. So some of these are listed here, but there's not actually any of them available to trade, which means the limit order book is just empty. There's not actually any of them there. And you can see the ones that are way far away, like $55, there's just not that much activity. But if you take the ones that are much closer to the price here, so the ones that are close to 101, 102, you can see with those ones there's a lot of activity. So the liquidity of the options very much depends on where the price is and how long it has till expiration. Any questions about that? So this is information you get for the option market. And if you click on any one of these, you can get a detailed quote for that option. And you can see they have long names here because it gives the date and everything else about it. If you click on one, it gives you just basic information here. And you can see that there's volume in that one. It's trading a little bit, but not nearly as fast as the stock was trading. So the two big measures of liquidity for options here, you got both volume and open interest. So open interest, again, that's kind of like volume is the same as it is for stock. How many contracts have actually traded? Open interest would be equivalent to like shares outstanding for a stock. How many shares there are, although here it's how many options there are. Any questions about the option information? And then so you got all these call options, and then down here, then you got all the put options. And you can see a put option of 55, with strike price of 55 is worthless, because that's saying you could sell Apple stock for $55 if you had this option. But you wouldn't want to sell it for $55 because you could sell it for $101.32. So you wouldn't want to sell it for $55. So that option is worth almost nothing. It's worth 2 cents if you want to buy it.
Is there a requirement for how many you have to buy options? Like the amount?
No real requirement. It's just it wouldn't be worthwhile if they're not worth much. And not all stocks have options. It has to be a stock. There just have to be enough interest in it. So Apple's really actively traded, so there's lots of options. If you're a little stock that nobody's heard of, they probably won't have any options traded on you. So it all depends on what investor interest is and whether it's worthwhile for the market to do it.
So I'm confused how it works. You pay, what, the 2 cents to have the option to sell, and then you sell it for that price?
Yeah, so with this, with the call option, it's probably easier to follow. So if we had the last one here, 145, you could buy this option right now for 2 cents. And then what you could do is once you've paid your 2 cents and you own this option, what you could do then is you could pay $145 and they'll give you a share of Apple stock. Whoever you make the, so this is a contract with somebody else, with the options exchange, which has been a contract through an investment bank. And first of all, you pay them 2 cents for the option. And then if you want to, what you can do is you can exercise the option. And by exercising it, you pay an additional $145 and you receive 1 share of Apple stock.
And you have until that date to buy it.
Yeah, and this expires on March 11th. So if you don't exercise it by then, and the expiration date for, these are what we call American options, which means you can only exercise it on March 11th. If it was what we call a European option, you could exercise it at any point up until March 11th, so you could execute it today. But this one, you can only do it on March 11th. So on March 11th, you can choose to pay $145 and get 1 share of Apple stock, which then you can then sell for $101, so you'll lose $55 roughly, or yeah, $45. So you probably would not exercise it, but there's that ever so small chance that Apple stock will double in price by then and be worth $200, and then you would make some profit with this. And the thing is, if you know Apple stock is going to go up, if somehow you could predict the future and you knew Apple stock was going to go up to $200, and you only had, $100 to invest, you could either buy 1 share of Apple stock and then you'd make that $99 profit, or you could buy whatever, a couple hundred of these options, and when it goes up to be worth, when Apple stock goes up to be worth $200, this option would be then worth about $55, and you would own a couple hundred of them, so you'd make thousands and thousands of dollars of profit. So you can greatly leverage your profit and get a huge amount more profit by trading options than you could directly by buying the stock. Basically, you could buy hundreds of options for the price of 1 share of stock. So it really, it's not exactly leverage, but it works very much the same as leverage. It really changes how much an investor can invest and how much profit, as well as how much money you could lose. Because then if the Apple stock price doesn't go up to $200, if you bought the stock, you still got a stock worth $101, but if you bought the options, they're all worth 0, and they expire and you lose everything. So it's a very high risk, high return strategy to trade in options compared to trading in the stock. Other questions about it? Okay, other stuff we have here. So that's the options section of what you could get for information on a stock traded here. You also have here historical prices. If we click on those, these are the historical stock prices for Apple. These are stock prices, not option prices. So this is coming from the stock quote. And this is one of the actually more useful things in terms of any real analysis. Because any formal financial analysis, what we like to work with, what we're concerned with is returns. So again, with bonds, we don't care about bond prices much, we care about bond yields. With stocks, it's the same thing. Any kind of real analysis, you don't care so much about the stock price, you care about the return. So you care about these percentage changes in the price. And if you look just at the quote you get for a stock, you don't actually get the return given to you very much. The only return you have given here on a stock quote is this little intraday return, which is changing all the time, and it's only for one day, so it's actually fairly useless. What we would really care about if we want to do any real analysis of Apple is what its, say, 1 year return was. And we don't have the 1 year return given to us, or 1 month return, something like that. It's not actually given here. So we'd actually have to go and compute it ourselves if we wanted to do any formal analysis or any real serious financial analysis of Apple's stock here. But the way we could get returns is if we took these historical prices, we could use them to compute returns for Apple. And so if we look at doing that, we click on prices and it opens those prices for us. You can get these prices given ever since Apple first listed on the stock market, which was apparently December 12th, 1980. And again, the first listing, so this first trading day, December 12th, 1980, that was the primary market for Apple. That was its IPO. And then every day since then has been the secondary market. So again, there was one day when they had their IPO, the primary market, and then there's been thousands of days of secondary market trading for Apple. And if we wanted to look at their returns, they give the, again, opening price, the high price for the day, low price for the day, the closing price. They give volume every day, and then they give the adjusted closing price. The adjusted closing price, that's the price plus any dividend that was paid. And dividends aren't paid every day. They're paid quarterly for stocks most of the time. So you'll see if you go back once a quarter, you'll have in here that there's a dividend paid. And the dividend here, you see it's 52 cents. That's how much Apple's quarterly dividend is. So if you looked at that, the stock quote, you see it says the dividend here is 208. That'd be the dividend for the whole year. So for the full year, Apple pays a dividend of $2.08 per share. But since it's paid quarterly, it's actually going to be 1/4 of that 4 times a year. So it kind of works like bond interest. It's except here instead of being semi-annual, it's quarterly for stocks, where bonds were semi-annual. So if you take 208 divided by 4, that gives you 52 cents per share every quarter. And actually working with that yourself is kind of a pain. That's why the adjusted closing price is so much better to work with, because it has those dividends basically added into the price. And if we wanted to work with Apple and say look at what its returns were, we can download all this to a spreadsheet. So the way I would go about doing that, I'll take monthly instead of daily, just because monthly is going to be easier to work with. And we can do it over the past, say, 5 years. So I'll take February 1st, 2011 till March 1st, 2016. And I wanted to do monthly. So I'll change the dates and I'll do this. And then what I can do is I can download it. Down here there's a link to download to a spreadsheet. And I'll download it all to Excel. And I will open it. And get my spreadsheet here. And so what I have now, I'm going to make it an Excel sheet. And so this is just those monthly stock prices for Apple from March 2016 back until February of 2011. And the reason I did it back to February is because if I want to compute returns, remember the formula for computing a return, you want to take the current price minus the previous price divided by the previous price. Since you got to take the price one period before, you need to start one period before whenever you want to start getting the return. So if I want to go back an even 5 years here, if I counted the years right, then I'd have to go back not to March 2011, but February 2011, so 1 month earlier. That's why I had to take it back one period more. And if I want to compute returns, I don't need any of this open, high, low, or close, and I don't need volume. All I need is that adjusted closing price. And so I'm going to delete everything else so it's easier to work with. And I'm just going to look at this adjusted closing price. And this is similar to what we did earlier in the semester. So this is the most recent price. This is the price one period before. If I want to compute returns, I just got to take then the current price minus the previous price divided by the previous price. That would give me the return. And that would be a 1 month return. And that's what the return was here over 1 month. And so Apple's 1 month return here right now is 3.97%, so about 4%. And this one actually you can do in your mouth. So it went from $96 to $100. That's a $4 increase. So that's about 4%, really roughly. So that's kind of what it is, 3.97%. And the easy thing in Excel is once I can just double click and it'll drag it all the way down for all those months. So I've got all my monthly returns here. And then the first one you see, because it's using from one period before, the first one is not going to give a value. So I've got from March of 2011 up until March of 2016, so that should be an even 5 years of returns that I have there. On the assignment, there was a typo, it's been corrected, and there was an announcement, and I said about it in class last time. In the assignment, you want to get, so I just took 5 years of monthly returns here. In the assignment, you want 3 years of monthly returns. The dates, though, only gave you like 2.5 years. So in the assignment, you used 3 full years, and it's updated and corrected. So if you look there, I think I'd asked from 2012, but it should have been 2000, or I asked until 2013, but it should have been back to 2012. Look at it so you get an even 36 months on the assignment. And it's on there now, so if you look at it, it should be clear. All right, so that gives me all those monthly returns. Now, with monthly returns, we got a couple of different periods here. What we would like to say then is what the return was over this 5-year period. But if we want to talk about returns over this full 5-year period, there's several different ways we could compute that return over a longer period like this. So we've got, we need to take an average return. And there's 3 different sort of time periods we could work with here. Sorry, here I took a total 5-year period. So we could talk about returns over the entire 5-year period. We could talk about annual returns, like average returns each year for those 5 years. Or we could talk about monthly returns, because we've got a whole bunch of monthly returns here right now. So we got kind of 3 different time frequencies or time spans we could talk about. And so ideally what we could talk about, we could talk about total returns, average returns, different ways we could measure the returns over a time period like this. The first way we would want to do this is what's called an arithmetic average return. This is just going to be the average return over this 5-year period. And first I want to count how many returns I have. There's a count function in Excel which can be useful for this. And if you don't count, then you got to look at what row you start at, what row you end, and you got to like subtract 2 numbers. And if you can't subtract 2 numbers, you can let Excel just count it for you. So if I count it, there's 61 return observations there. From this row down to this row. So I did that count function on all of these. Because actually I have one more return observation than I need actually. So I've actually got 61 monthly returns here. So I used the equals count, and then I just highlighted all those returns that I had computed. So I get 61 returns altogether. What I can do first of all to get the average return, there's the average function in Excel. If I just do equals average, and then I highlight all those returns, then I would get the total number of returns I have over that period. That's going to be the average return, average monthly return. I'll do it as a percentage. So the average monthly return for Apple over this 61-month period was 1.51% per month. And that's just a simple average. And so by being a simple average, that does not consider time value of money at all. If I take an annual return, I just take that monthly return times the number of months in the year, which is 12. So if I take that times 12, that would give me an estimate of the annual return for Apple over this period, which is 18.16%. I shouldn't really call it an annual return. It's actually an annualized return. If I wanted the annual return, I would have to actually go and compute the price, not monthly, but from 1 year to the year before. And then over the entire 5-year period, if I take that times 5, I would get what the Apple's return is over a 5-year period. So over the 5-year period, Apple's had a return, an average return of about 90%, 91%. That again does not consider time value of money. And by not considering time value of money, what I mean is that's not the return you would get if you bought Apple at the beginning of the period and then held it to the end of the 5-year period. Because if you bought and hold, you'd get this compound return. This is the return you get if you bought it in the first month, held it, and then sold it at the end of the month, and then started over with whatever your original investment amount was. And you did that every month for 5 years. And then you took your average profit over all those 5 years of monthly returns. It'd be kind of a weird way of doing it, so it doesn't really make sense financially. But it's easier to compute this way, so it's often computed like this. If instead we looked at it sort of more properly, time value of money, what we'd want to do is we want to look at the compounding effect here. So if we wanted to look at the return over the full 5-year period, what we could do is we could compute the return, and this I'll call a holding period return. GAR stands for a geometric average return. I'll come back to that in a second. The holding period return, that's just the return over the full 5-year period. So if I take, again, the same idea, if I take my ending price minus my starting price, but now not the price one period before, but if I take the whole 5-year period, then the starting price is whatever price we started with back here at the very beginning. So if I take the ending price minus the starting price, divided by that starting price, what I get is the return that you actually get over the full 5-year period. So what I did is it's the same ending price minus starting price divided by starting price, but now I'm looking at the beginning of the whole 5 years rather than just 1 month before. So that would be your total return that you actually earn over the full 5-year period. It's 115%. So that return is greater than the 90.82% because that includes the compound effect if you kind of roll that over every month for the full 5-year period. Whereas the 90.82 is kind of like you invest and then you withdraw your profits every month and then you reinvest the starting amount. You get a different sort of average return. Yes?
If there is a stock split,
Yes. Yeah, that would mess up everything normally. That's why that adjusted closing price that's given in the stock quote there, it includes stock splits. So that adjusted closing price, it adjusts not just for dividends, but it adjusts for splits or any other changes in shares outstanding. If you actually had the actual share price every day, it would be a horrible, tedious mess to go in and adjust for splits and stuff. It would be a big mess. So that adjusted closing price is really useful for this because it already adjusts for all that for you. That's actually very good to think of. Other questions about this holding period return? So HPR stands for a holding period return. Let me write what those abbreviations were. So the values that I'm computing here. So AAR is the arithmetic average return. GAR stands for geometric average return. And HPR stands for holding period return. That's what those abbreviations stand for. And a holding period return, it's kind of like an effective rate, but instead of being for 1 year, it's for a multi-year period. So it's a period of however long you're holding an investment. Other than that, you can compute it the same as with an effective rate. And the GAR would be like the period rate then. So if you think back to the formula we've had several times so far, if this is for the full 5-year period, and it's like an effective rate, and we want to know what it was monthly, so we think of monthly as being like a period rate. Do you remember how to convert an effective rate back to a period rate? Nobody remembers it. I remember it. But I'm supposed to remember it. You need to use a formula that looks something like this if I type it out in Excel. I'll call it the 1 plus the HBR, and then that little sign, that means an exponent. The exponent is 1 over the number of periods is what you have in your exponent. And then it'd be all that minus 1. And then I need another parentheses. That's how you could get again a period rate from an effective rate if we take that HBR as being like the effective rate. So again, you just take 1 plus the return, and then the exponent is 1 over the number of periods, and then minus 1. And so the GAR, what it is, it's really the same thing as the HBR, just over a different time frame. So if you took the HBR and you expressed it per month or per year, it'd be a geometric average return, and you just change that number of periods. So if I do that calculation here, what I can do to compute this is I take equals 1 plus my effective rate, and then the exponent is 1 over the number of periods. And since I did this count here, that's why it's easy to have that. That's the total number of periods that I have, 61. And then minus 1. And I need another parenthesis in there. That looks like a big messy formula, but it's the same formula we've had several times previously, actually, just in a different location here. And what I get is I get this number. So that was the formula there. And it gives me this number here. Uh, 1.26%. So 1.26%, that is like the return I get each month from owning this stock. If I rolled over that investment and I considered all the time value of money, the compounding effect of owning it, that's actually monthly return you would actually get owning stock in Apple over this 5-year period. 1.26% per month. And one thing you can see, compared to that arithmetic average, you see your monthly return here is lower, but your holding period return is higher than the arithmetic average was. And that's because here, because you get compound interest that you're earning, you don't have to start with as much. So you can have a lower return per month, but you're going to end up with a bigger amount for the whole period because you get this compound, it's like compound interest. You get this time value of money effect. And then we can annualize either of those. To annualize it, I can take 1 plus that monthly return, and then if I take the exponent as being the number of months, so with an exponent 12, and then minus 1, that would give me what that would be per year that I earned from owning Apple. So here I earn 16.27% per year. And if I were to do the kind of equivalent thing, if I take 1 plus the 5-year return, and I make the exponent be 1 over 5, then minus 1, I get almost the same thing. It's not exactly that because I used 61 months instead of 60 months. So there's not exactly 5 years here. But I get something close. Actually, I should adjust it to make it exactly 5 years. But I'll do that next time. So you get these amounts here, and so they're kind of looking at the same thing. It's just whether you're looking at it monthly or per year or for the whole 5 years. Yes? No question? Oh, I thought you were going to have a question. Yes?
So what's the formula for HBR?
It's the same formula that we used to get the GAR, but now just the number of periods, instead of being 61 months, it's just 5 years. So it's 1 over 5 instead of 1 over 61. Other questions about it? Yeah. So here, I basically compounded it by 12. So I took the monthly return, and then the exponent was 12, because there's 12 months in the year. So it's 1 plus that monthly return, and then the exponent being 12. And it gave me that. So with arithmetic returns, if you want to annualize it, you just do it times 12. With geometric averages, you got to do it not times 12, but you got to do 1 plus the return to the 12th power, and then minus 1. So that's why it's a geometric average instead of an arithmetic average. So those are ways of working with these returns. And as far as what return to use, it depends if you want, again, the period you want, whether you want monthly, annual, or over the whole period. So you can kind of compute it each way. Another way that you can do this will be a lot easier in some situations. If you think of the way we get this return over the entire period, there's a couple other ways you could do it, and they're really just rearranging the order in which we did these things, but it can be really useful to look at that. So 2 other ways you can get that holding period return. One way, we could use the future value function. So to get it with the future, we could use the rate function in Excel. So if we take the rate function, what we need is, first of all, the number of periods. Number of periods we have here are, we can do it 3 different ways. If we're looking at the whole 5-year period, we have 1 period. We're looking at 1 5-year period. There's no payment amount, so that's going to be 0. The present value, the amount we start with, I'll put it negative. That would be whatever this starting price was. And then the future value, the amount we're ending with, is this ending price. So if I take those and I compute that, you see that also gives me the same thing. So that's doing the same thing, but just using the rate function. And if I wanted to do that for each of these, I could do it here too. Number of periods, so if I'm looking at annualized, this is where it comes out. The number of periods that I have here, as far as the number of years, technically it's going to be 61 divided by 12, because I didn't use an even number of years here. Normally that would be 5. It's going to be about 5, but it's not exactly 5 here. Payment 0, and then present value again is that starting amount, and the future value is the ending amount. And you see I get 16.27. If I use exactly 5, I'd get that 16.56. So it depends whether I'm using exactly 5 years or whether I actually use 61 divided by 12. And then to get this one here, again, we can use the rate function. The number of periods here is going to be 61 periods, no payment. The present value is that starting price, and then the ending value is the ending value. And if I do those, it gives me 1.26. So you see, you can use those same things with like the time value money functions that are built in Excel. It's just usually harder that way, so you usually don't need to do it that way. But if you got really used to using that rate function, you can see how it works here, how it gives you the same thing. It's just rearranging the steps. Another way you could do it is the return you get over an entire period. This is the compounded return. If you think about time value money, what it is, it's taking your return every month and compounding it. So when you compound it, it's 1 plus the return in the first month, times 1 plus the return in the second month, times 1 plus the return in the third month, and it's doing that 61 times, and then minus 1. We can actually do that calculation here. What we would need, though, is a column for 1 plus return. And if I compute 1 plus the return every month, and then it drags it down easy enough, so it gives me that for all the months. And then what I could do is there's a product function in Excel. So product just means multiply everything together. So if I take the product of all those 1 plus returns, and then minus 1, that would also give me the same thing here. So 3 different ways to get the same thing for the holding period return. Just there's different functions in Excel you can use, and use whichever one is easiest. In certain problems, it'll be easier to use one as opposed to the other, so just whichever one's easiest is what you should use. The different ones are going to have a different amount of easiest. One last thing to look at. These are all giving us measures of the average return. Another thing that we're usually very interested in finance, especially in any kind of investment scenario, is how risky a given stock is. In Excel, it's pretty easy to measure the risk of a stock if we want to do it by the standard deviation of returns. And this isn't a statistics class, so we don't need to go into the whole theory of the standard deviation. But the standard deviation basically gives an idea of how much variation there is in that monthly return. It's kind of like the range, how far up and how far down those Apple stock returns go. And in Excel, it's easy to compute. There's a function, STDEV, which would give us the standard deviation of monthly returns. So if I use that STDEV and I highlight all those monthly returns, then it computes it for me. And I can do it also here, I'll do it as a percentage. So 7.17%. So it's easy to compute, but it's not much use if you can't interpret it. The interpretation of that standard deviation, that's basically saying in a typical month, Apple's stock return is 1.51%. So the average, arithmetic average, what that is, that's what the return is in a typical month. So if you took just 1 month out of those 61 months and said, what's your expected return or your average return, it'd be 1.51%, especially because we're not looking at compounding, then we're looking at just 1 month. So the arithmetic average is what we use. If we say, what's your return if you hold it for the entire period per month, then you'd have 1.26%. But your average 1 month return is 1.51% plus or minus 7.17. So that standard deviation kind of gives you this plus or minus range, how much uncertainty you have about the return in any 1 month. And why we use the standard deviation, that is the whole science of statistics. It's going to take a whole statistics class, and that's why I use the standard deviation to measure that. Because if stock returns are normally distributed, which they are not actually, but we can pretend they are, then they fit this normal distribution, and that's what the standard deviation gives us, how much the returns can vary from 1 month to the next. And so it measures risk of the stock. Any questions? Okay, you have a lot what you can do with the assignment. Actually, you have most of what you need for the assignment now. We'll continue with this next time. The next time, we'll look more similar stuff, but for the indexes or the indices and some of these other securities that trade in the stock market. We'll look at that next time.